Hello to all of you. Well, wonderful to have you all online. I don't know how many of you were there for the lunchtime session of this. And again, if you're in a different time zone, so be it. But the earlier recording, we actually went into a lot of detail around some financial lingo. I'm sure the left brain people were eating it up and loving it, and the right brain people wanted to kill themselves. Just in terms of, but anyway, Lee, wonderful to have you. Thanks for setting this up. And yeah, I think it's just you and I tonight running through portfolio planning.
Absolutely. Welcome everybody to our first Power Hour with Scott of 2020. We look forward to starting it off with learning, just as the previous session that we had at lunchtime, where the recordings will be sent out, and for this evening. So as always, ask your questions. I will be monitoring the chat boxes for any questions that you have, and I'll make sure that we keep Scott on as long as possible and get all those questions answered.
As Lee said, I've if my hair's looking a little bit weird, it's because I've just come off the boat. Lee had me working hard tonight, and it was actually Kelly's birthday, so we had to go for an early dinner. So we went for a boat ride, and that's what happens when you go on the boat, basically. So as you said, Lee, we do live in an amazing place. It's very, very hot here today, and it's awesome to be able to jump on the boat and drive to a late lunch, early dinner, and drive back and run a webinar. So it is where the world is going, and I probably think it's quite a good interlude into what we're trying to achieve tonight, because I don't believe there's any such thing as an overnight success. I don't believe there's any such thing as a get-rich-quick scheme. And when people say to me, well, how did you manage to, own a boat, or be able to go on a boat, at 4 o'clock in the afternoon, etc. My answer would be that I bought my first property when I was 22 years old, back in 1999. And what was really interesting is that it was my first year in London, and all my friends would go out and party, and we couldn't because we had to pay the mortgage. And then when we bought our first house in London when we were 24, our friends would go out and party even more, and we would, or even go on holidays and whatever, and we couldn't. We had to pay the mortgage. And so I've always found property to be an incredible savings account, because you can't take it out. And it seems to be you just pay in all the time. But over time, if you do it right, it starts to be a little piggy bank that pays you out. And I think it's quite a nice little interlude into what we're talking about tonight when we're talking around portfolio strategy, and more importantly, how do you grow wealth over time. But I want to be very clear that what we're going to share with you tonight, there's nothing that'll get you rich by the end of 2020. Nothing, not one thing. But what we can do is what many people say is you overestimate what you can do in a year, but you underestimate what you can do in a decade. And my challenge would be to start thinking, what can I do by the end of 2030? What can I do by 2040? In my case, I actually did the maths. Funny enough, this exercise has been amazing, because I did the maths on 20 years. And 20 years sounds like a hell of a long time, but I'm 42 years old. That puts me at 62 years old. Which is still technically 3 years before retirement. And I only talk about these personal stories because we're going to run through these exercises tonight. But when I was preparing last night, it was like, those numbers are pretty interesting considering 20 years, etc., etc., etc. So I just ask you to come with that attitude. And although 20 years sounds like a lifetime away, it's actually not that much. You'll be surprised how we all know how fast decades go, and it's what you do today that ultimately is going to help you succeed. I love that saying that successful people do today what others don't want to do, so that one day they don't have to do what others have to do. And hopefully tonight's all about that. So let's rock and roll. I'm going to give you a quick introduction into just the overview. If you haven't been to a Wealth Migrate webinar or WealthE Wednesday, I'm literally going to zoom through this so quickly. But we live up to, and why do we do these things? It's all around Zig Ziglar. You can have anything you want in life if you help enough other people get what they want. That's what we're passionate about. We're passionate about helping people find their freedom. We talk a lot about the golden inner circle. I highly recommend that you go and check out Simon Sinek. And he says most people are trying to figure out the how and the what. Now, tonight's going to be a lot about the how and the what, but you've got to get clear on your why. And I'm going to talk a little bit about, your why. And when you get clear on your why, then you can figure out your how and your what. My why was that, and I'm not going to go into all the details, but my dad died at the age of 59, and he did what we were all taught to do. He went to school, he went to university, he got a great job, he invested, he trusted the financial industry, he paid his taxes, blah, blah, blah. And yet at 59, he died broke. And this is a picture of me and my dad on my first property project when I was 13 years old. And I decided there had to be another way. I love the game of Monopoly, and I love technology. And we've always dreamed about how could we marry property or real estate together with technology, and how could we take the game of Monopoly and ultimately, turn it into a real life game. And then growing up in Africa, the wealth gap it's in your face, income inequality, etc. And for me, it was something that really needed to be solved. When you look at wealth, 49% of the world's wealth is held in real estate, and yet only 12.9% of the world's population has access. Of that 12.9%, less than 1%. So all of us in this group, pretty much that are on this call, probably already have access to property, but less than 1% of us is going to retire wealthy at the age of 65, and I just think that's disgusting. And so that's, as a team, one of the things we're passionate about is how do we bridge that gap, and how do we help the 99% invest like the top 1%. Our vision is to make investing as simple as the swipe of a finger, and ultimately to get it down to $1. Now, we're not at $1 yet, but we're making steady progress towards that goal year on year. When one looks at the old system, it's broken. If you're an investor over here and you're trying to invest in a deal, there's actually 16 different middlemen between you and your investment. There's fees all the way through the process, and most people don't trust the system. There's no transparency, and because of the high fees, there's no returns. And we had a fascinating meeting today, which if I've got time, remind me, Lee, I can talk about it at the end. But it's a business that's only ever been pitched at people that could invest 20 million Rand, which is about $1.5 million. If you turn up with $100,000, they basically, are prepared to start talking to you. But if you turn up with anything less than that, they're not interested. And it's just interesting because it's amazing how the system is only built for people that have $1 million, $2 million and up. And yet, really the 99% is, want access to the same opportunity without all the fees. What is our model? It's very simple. We go out and we find trusted quality property partners or real estate partners in England, Australia, America. We're now talking to people in South Africa and in Europe, and they list the properties on the platform. We then, you and I as global investors, get access to those, and then we go through 4 simple steps. We sign up, in a compliant way. We select the investment, we transact online, and then we manage our global portfolio in one place. So, what used to be very difficult with hassles and management and maintenance, and that's not even taking into account banking and structures and tax, now can literally be done in minutes. People get access to quality partners, they get quality opportunities. Today is literally WealthE Wednesday, so you can invest today from $1,000, and soon we're going to be beta testing $100, which is really, really exciting, and it allows people just to focus on the best returns. And if you're worried, if you think you're the only person out there that's interested in this, you can be rest assured the platform's been going for 6 years now. We've got members in 133 countries. We've done over $600 million worth of deals. We've had nearly $100 million invested through the platform. We've paid out over $12 million in dividends, and we've won numerous different awards. And one of the things I'm proudest of for our team is that we've got a higher than 70% reinvestment rate. So that's where people invest and then they reinvest. If you want to look at the deals and the actual deals, my suggestion is to go to the platform. And again, if we've got time later, I'll go to the platform. All the information is there, and the purpose of WealthE Wednesday is to be here to answer any questions that you want to know about the platform, the deals, the due diligence, or anything else. But equally, particularly in the evening session, we try and make it more of a learning session. What we did in December was goals. Now we're about to embark, or we've already embarked on a new decade. I'm a big believer in goals. I fundamentally believe, I love that saying by Da Vinci, that he dreams his painting and then he paints his dream. I fundamentally believe that we create our futures and it starts in our head. Now, I'm not going to go through all the different topics, but if you missed last month's WealthE Wednesday, look for it on social media or put a post up on the chat box. You should be able to find the chat box there and just type in goals and we can share it with you. But a very powerful session on goals, and we've had a lot of very positive feedback with regards to it. But what are we looking at tonight? What is the learning tonight? And I think I'm proud to say we did that in 10 minutes because it's just an intro. Tonight, we're going to be looking at portfolio strategy and how you grow yourself to wealth. Now, it is very hot here, so I'm going to be stopping every now and again to drink some water. But while I do, I'd love to know what people think portfolio strategy is. So if you just want to type it, there's a chat box, and if you can literally just type, what is portfolio strategy and what does it mean to you? And while you're doing that, Jay, thank you very much for your comment and Money Revealed. I must admit, I know Jeff Hayes very well. I've known him since 2014. I met him in Bali many years ago. I've got huge respect for what they're doing, and yeah, it was an honor to be part of that. I will answer the rest of your question later, but I see what you're saying here in terms of the next 10 years, and we'll be 80 in 20 years. Son is 19. I think the beauty of what we're all doing is that. So I'm just reading through your question here. So don't worry about the length. There's no problem with the length. So we've got here investing, but I will answer, Jay, if there's anything else I can answer. I mean, one of the things with your son being 19, I just had lunch or dinner, I don't know what you call it, with a young man that turns 18 tomorrow. He earned $200 working all through Christmas. And how many, 17 turning 18 tomorrow would go out and just blow it and buy new shoes? Lee, you don't even know this. But he said to me, Scott, how do I invest my $200 on your platform? How's that for, investing in his future? Which ironically is a fantastic. So we've got diversification, we've got structure across assets, different classes, goals for wealth, diversity, uncorrelated bets. When will a new investment platform be available on My Wealth? When will new, so I'm not sure on My Wealth. Having a portfolio that works within my personality style with my goals. So let's rock and roll here. And it's fascinating what I just told you, the story of Bongi, and the fact that he's 17 turning 18 tomorrow and wants to start investing. Because, Albert Einstein said compound interest is the eighth wonder of the world. And I found this, oh, apologies. Oh, my word. And I found this literally last night. I mean, we all know it, but I like it because it's visual. And if you start investing, when you're 25, you can see at the top here in purple, you can see how much you will have by the time you're 65. If you start investing at 35, you can see how much you'll have. And if you start at 40, but with double the amount of money, you can see where you end up. Okay, so you still don't beat when you started at 20, but you do beat when you started at 35. But you've got to do double. So it's just really interesting. Now, tonight I'm going to share with you the maths around how this actually works. And this is what tickles my brain because it's actually, you can work this out. So let's run through a couple of slides. Now, I love our inner circle, and I actually forget the person's name who I need to compliment here, but they shared these slides literally on our inner circle. Now, inner circle is our growing community. There's 4 parts to it. You get the knowledge, you get the community, you get to invest, and you get to be part of the purposeful journey. And we've got WhatsApp groups, we've got social media groups, and this was an example of someone sharing and the value that they're sharing with the community. Well, I got a lot of value out of it as well because I love these pictures, so because they're really simple. So what is compound interest? It's ultimately reinvesting your money earned from the initial investment. As we said, Albert Einstein, the most powerful force in the world. And ultimately, you invest, you earn, you reinvest, you earn more, you reinvest. And like we all learned in Monopoly, ultimately, 1 becomes 2, 2 becomes 4, 4 becomes 8, etc. over time. In terms of investing in real estate, we talk we talk a lot about the benefits of real estate. Like I said to you already, 49% of the world's wealth is held in real estate. But to do it, and again, the purpose of tonight is not to go into this detail, although Lee's got me working on the Wealth Accelerator, which I'll talk about later, which is all around the how, but it's market knowledge, analysis, managing risk, finance, exit strategies. There's multiple types of real estate. We all learned in Monopoly, it's about diversification, location, patience, and not going to jail, which I thought was quite funny. And then the benefits, tax deduction, tangibility, and a cash return. Risk and reward. I quite like this. And if you look here, you know, the risk is what's the uncertainty of loss. The reward is obviously the gain of the investment. There's different types of investment where the risk increases and the reward decreases. The reward increases this way. And what I think is quite important is that Lyndon spent a lot of time in the earlier session. So if you didn't listen to the earlier session, it's completely different from this session. And Lyndon did a lot on risk and reward and even understanding our platform and how we go about it. You've got the different styles of investing between aggressive and conservative. You've also got how risk is calculated, comparing the prices, etc. And I'm going to go into that tonight to show you the different numbers. This is a fascinating rule, and I'm not sure if you've heard of it before, but it's called the rule of 72. And it's how much time will it take to double your money. And ultimately, what you do is you just divide 72 by the interest rate. Or by the rate of return, and ultimately that is the number of years it'll take to double your money. Now, I believe there's a better way of doing that, and that's actually, we're going to talk about IRR, which is internal rate of return, which ultimately takes into account time value of money. And it's as simple as take 100 and divide it by the IRR, and you can work out how quickly you'll double your money. Asset allocation, you know, again, we help people invest in real estate. You know, very few people would think that you should put all your money into real estate. I'm probably not the right person to speak to because I'm pretty much, you know, I'm quite heavy in business and quite heavy in real estate. I'm very light in stock market and other investments because it's two things I like. I love business and I love real estate. So, but there are many different things that people can diversify into and look at. And again, I'm not going to talk about that tonight. And then finally, opportunity cost. And you know, this is a good one for when we talk about Bongi. You know, the guy made $200. He could go out and buy himself, you know, a new pair of shoes, and all he will have is a nice new pair of shoes that within about a year will fall apart. And or he can start investing, and you can just imagine what he's going to achieve over, you know, at the age of 18, getting started and investing, you know, on this journey basically. So let's start getting into some of the lingo. Now, the two favorite terms that people like to use are ROI versus IRR. ROI is return on investment. IRR is internal rate of return. You can see here the breakdown and all the financial lingo and how complicated it can get. There's also some stuff here which we've got some links. I don't know, Lee, if you've got this link or if you can put it. I'll put it in the chat box for everybody, so that people can go and get it in terms of IRR. Now, in simple terms, I'm not going to read through this because it's on the screen for you all to read if you want to. But ROI is really a basic formula. You know, if you put in $100 and you make $100, then your ROI is 100%. The challenge with it is it doesn't take into account all the different variables and doesn't take into account time value of money. IRR, on the other hand, takes into account time value of money, and it's actually got a very complicated definition. Which again, you know, is the interest rate at which the net present value of all the cash flows, both positive and negative, from a project or investment equals zero. Internal rate of return is used to calculate the attractiveness of a project, blah, 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 blah. It's all financial lingo, and that's not what I'm interested in. What I'm interested in people understanding is that you don't really need to understand how to calculate IRR. If you want to, you can go and look up all the formulas. You can look at the link that I've just put in there around what is IRR. But in simple terms, what IRR is it takes the capital growth and it takes the income and it takes 25 other variables. So there's 27 variables, including time value of money. And it gives you a return on the capital you're investing in today's money. What that allows you to do is to compare an apple with an apple. You can compare a property investment in China with a property investment in America. You can compare investing in a property in America with investing in the stock market. You can compare it with investing in fine art or cryptocurrencies or anything else. Because whether you invest for a day or whether you invest for 10 years, it takes into account time value of money. And so what I believe is important, and I said this at lunch, it's not that critical to understand how to calculate IRR, but what is really important is to understand what is IRR and how to actually use it to your benefit, basically. And I quite like this little graph that I found, which is ultimately that when we invest, you know, we invest a certain amount of capital. So effectively we go into negative cash flow, and then we get, you know, cash flow every month or year. And ultimately our cash flow, you know, ultimately hits a neutral point because we've got cash flow back, and then it continues to pay us a positive cash flow. And ultimately, you accumulate all the cash flow plus the capital you put in on the back end, plus the capital growth you get on the capital you put in on the front end, the capital growth you get on the back end. You take time value of money into account, and ultimately it gives you a return in terms of what you can look at. Now, Lee, before I go on, because we're now going to go into the spreadsheets, is there anything you want to add to that, or any questions you have around the IRR calculations, etc.? I am going to explain it better on spreadsheets, I think, when people visually see it.
Yeah, there's nothing more that I can want to add. IRR always gets my knickers in a twist. So when we see it on the spreadsheet, maybe it will help. I don't see any direct questions coming through on the group about IRR at the moment. So I think we just carry on.
Perfect. And again, I want to repeat what I said, is that, you don't have to sit. When I drive my car, I have no idea how my car works, but I know that I have to put my key in, I know how to switch it on, and I know how to get from A to B. You don't have to actually know how to calculate IRR. On the assumption that you are getting the right information and you're dealing with trusted partners, if the IRR is 10 or 20 or 50, you know that that's the number. And there's plenty of free calculators out there, by the way, including that link I sent. There's a free calculator on that, where you can actually go and just calculate the IRR. You can do it on a spreadsheet, and really it's not that complicated. But what is important is if you know how to use it. So I spoke about my why, okay? And remember I said you got to get clear on your why, and then once you're clear on your why, you can go to your how and your what. So my son, about 2 years ago, I did this. I'm going to close off my WhatsApp so that you don't see all these messages coming through. My son was 5 years old, and I said, okay, well, I'm not sure if he's going to go to university in South Africa, which is where he lives. So what would it take to send him to a university, an average university in Australia, America, or England? Now, that's not a South African thing. People in India want to do that, all over the emerging world, China and everywhere else. Or what would it take to send him to the most expensive university, the best university in Australia, which is Melbourne, the best in America, arguably, which is Harvard, and the best in England, which is arguably Oxford? And I did the maths, so you can see the tuition cost, the total cost, the total after 4 years, the exchange rate, and the total amount of dollars, US dollars, that I would need to be able to send my son. Now, whether my son wants to go to university in 15 years or whatever, I don't know, whatever, 13 years. But what I want to be able to do is have the freedom to be able to make those decisions. And so what the exercise tonight is not whether you should or shouldn't go to university. It's an exercise on getting clear on why you want something to happen. So what I did is I went along and I said, well, if I invest $100, okay, and if my return, my IRR is 6%, okay, and my term is 10 years, then I'm going to, after 10 years, I'm going to have $16,000 in future value. And if I closed that down, and if I take after tax, I'm going to have $11,000. So that's not good enough, because if you remember my goal, let's just look here, the lowest amount was 106,000. Okay, you with me so far? Lee, please jump if I'm losing you as well, because you can be my barometer on whether it's making sense.
No, we've got it so far, I think.
Okay, so now we look at a project, and most of the projects that we've had on Migrate have ranged in IRR between 13 to sort of 20%. So this was, I just took actual projects basically, and this one was 15.2%. So again, $100 with an IRR of 15% with a term of 10 years would give me a value of $28,000, which after tax would be $19,000. And if I did, if I could find something with a slightly higher IRR, 19%, you can start to see that it has quite a material impact. Okay, now, so I looked at it, and clearly $100 a month wasn't going to be good enough. So then I went and I said, okay, well, what about $500? If I do $500 at 6%, and for 10 years, you see the future value, you can see the after tax. Exactly the same equation. Okay, what about the exact same return? It's just $500. What would that mean? You can see I'm getting pretty close there. Okay, so $500 a month, I'm getting pretty close. Now, what I did on this table here is I went and put in those exact numbers. So 6, 15, and 19, and you can see there 100 times 10 years, 500 times 10 years. So you can actually see that 98 just wasn't covering the 106, but at a 19% return I actually was. So that's why it's in yellow, because I'm starting to be able to send them to some of the universities overseas and to have the freedom. And then I looked at it and I said, okay, well, what about if I did $1,000 a month and for 10 years, where would that leave me? And if it's 6%, now the reason I'm using 6% is what would it mean if you leave your money in the bank? Even 6% is quite aggressive, you know, by international standards in dollars or pounds or euros. But, you know, even for people in emerging markets, you know, India, China, South Africa, that, you know, you could argue you're getting 6%. And then you can see here, if I did it at, you know, I'm now getting up to 197 and 263. And if I go back at $1,000, you can actually see $1,000 over 10 years. I can now send my kid to any university. Sorry, I can send at the lower level, I can send them to the average universities, and at the higher level, I can send them to any university. And then what I did is I said, well, John T is only 5 at the time when I did this, so you know, I probably got 14 years. And so what would it actually mean if I did $1,000 for 14 years? I think you're starting to understand the maths of how this works, and ultimately it's the exact same equation. Boom, boom. Okay, and if you go back to the cost of tuition, you can now see that you can actually go to any university, and you know, even with cash, you can go to any university over 14 years. And if you're taking a 15% IRR, I can now send 2 children to university, and at 19%, I can send, you know, them to any of the universities, 2 children to any of the Oxford, Cambridges, you know, Harvards, etc. Now, are you with me so far? I'd love to get some feedback, Lee, and if anyone wants to type any feedback as to whether this is making sense, because there's a couple of steps in this process that I want to take you through, and I want to show you how simple it is to figure out. You can either work forwards or you can work backwards. I'm going to work forwards and I'm going to work backwards to show you both ways to be able to do it. And but you can start to see what it takes. Now, if I said save yourself $100 a month, or if I said yourself save $1,000 a month, or even $10,000, whatever the maths is, it's very hard to save money if you don't have an actual specific goal. But if you have a specific goal, like whether you're learning, you're wanting to get fitter, or you're trying to learn for an exam, or whether you're trying to save money, it's much easier if there's a specific goal that you can connect in with every single week, month, year, etc. So I think everyone so far is with us. Lee, any thoughts or comments or questions from your side so far?
No questions, but that was very well explained. Thank you very much. There are a few people that are coming through on the chat group also saying that it's well explained and they're understanding, so well done. Okay, so I want to be clear here. So we've now set a goal. Okay, we've said, so my goal, my why was to make sure I had the freedom. Now, whether I'm going to make John T pay to go to university or not, that's a whole separate conversation, because I paid for myself to go to university. But I, as a father, want to have the freedom to be able to make those choices. I don't want to be scratching around in 14 years' time. Now, let's look the other way. What's important to me? Well, one of the things that's very important to me is being able to retire. Okay, and what I mean by retire is I'm probably going to be like Richard Branson. I'll probably never retire because I love what I do. But I've done this calculation before for people, and I wanted to show them the maths. So my maths, and I'm being transparent with you, is that complete financial freedom for me is where I've got a passive income of $15,000 a month. I believe that $15,000 a month is enough to live comfortably in England, Australia, America, and live like a king in the emerging world. Okay, now, you're not flying helicopters, you're not driving big fancy boats, but you can certainly send your kids to a private school, you can have nice holidays, etc., etc. So please understand, you can make this number whatever you want it. You can make it $5,000. Please notice I'm using US dollars. It is, whether we like it or not, the global standard in terms of currency. And you can see my number is 15. Okay, but this is a spreadsheet. You can make this 5 if you want to. Okay, and what it automatically does is it multiplies. You know, what do you need for
for the year. So I'm going to go back to 15 because this is my number. And now, does that mean I only want to earn 15? No. If you did the goal planning session with me before Christmas, you'll know that my goal is actually to earn 100,000. So it's a goal I set when I was 27. It's to earn 100,000 pounds passive income per month. Okay, I want to be very clear there. That's my high end, like you know, I want to shoot the lights out type thing. My low end goal, as Tony Robbins says, there's shoulds and musts. My must is that I want to have a minimum of $15,000 passive income. Now, if we use property, okay, you could use anything. You could use the stock market, you could use anything, okay, but I'm going to use property because that's what I understand. And let's say that you've got a stable income producing asset. Now, a stable income producing asset might be shares in Coca-Cola. If you listen to Warren Buffett or my uncle and they love the stock market, they invest in things like Coca-Cola as a share because it pays dividends. So it's an income producing asset. So people that love the stock market, this is still true to any investment class. I'm just using property because it's what I understand. So now let's take a medical building as an example, and it's got a cash flow, a net cash flow. Now we spoke this morning about IRR and we spoke about cash flow. And I just want to repeat it because it's so important. So this morning we spoke about how internal rate of return takes into account your cash flow and your capital growth, whereas your cash on cash return only is your actual cash flow. It doesn't take into account your capital growth. Now, capital growth is lovely, but you can't live on capital growth. You can't go to your school, you know, for your children and say, listen, I want to pay you with capital growth. It doesn't work because the only way you can use capital growth is that you then need to sell, and when you sell, you incur tax. So actually, I believe the most important metric is what is your net cash on cash return? What income are you getting paid out positively on your investment? So, and I'm using simple numbers here. I know that you could get completely, much more complicated using inflation and using tax, and that then depends on what country you live in and what your tax rate is and everything else. I'm not getting that complicated. I'm trying very simply to show you how to do the maths. And so if you take an 8% cash on cash return, which we've been paying consistently now for more than 5 years to our investors, that would mean that if I want $180,000 a year at an 8% cash on cash return, I'm going to need capital of $2.25 million. Now, when you first hear $2.25 million, I'm sorry to be rude, but you probably SH1T yourself and go, how am I ever going to get $2 million or $2.25 million? I mean, am I right or wrong in that, Lee? When people see $2, $3, $4 million, they go, oh, I can't do this. It must be for someone else.
Yep, absolutely. As soon as you see that figure, the first thing is to close the books and walk away because it just seems insurmountable. So
one of the things that I've realized, and I haven't spoken about, this is the first webinar I've spoken about it, is that with the Wealth Accelerator, I've realized that there's really only 3 steps people need. They need belief, they need knowledge, and they need accessibility. And so what the purpose of this is belief. Okay, then we'll give you the knowledge, and through the platform, I believe we can give you the accessibility. So let's look at it. Okay, so for Scott Picken to get $15,000 a month, $180,000 a year, I would need a minimum after tax of $2.25 million. With me so far, yes or no?
Yep.
So if we go back, and you heard me talking about the 20 years, and now you can see where it's coming in here. I went and I said, well, if I leave my money in the bank at 6%, what's it going to give me? And if I and obviously an after-tax situation, and blow me down, if I invest $1,000 a month for 20 years, look at the difference between a 15% IRR and a 19% IRR after tax. Don't you think that's pretty interesting?
Just made your money.
Yeah, because it's compound interest. That's money on money. And can you see that if I can get a return, not even over 20%, so people are anywhere from sort of 15 to 20%. And again, in our platform, we're averaging sort of 13 to 20%. Because remember, you don't always want to be trying to shoot the lights out and losing capital. as Warren Buffett says, the number one law of investing is don't lose money. So again, it's about portfolio and strategy, and having some, higher return investments and some safer return investments. But can you see that at $1,000 a month, I can actually get very close to achieving my goal in the next 20 years. And then what I said to myself is I said, well, I don't really want to just eke by, and I certainly don't want to leave it as touch and go by the time I'm 62. So what if I did $2,000 a month? And just to show you here, if I did $2,000 a month at 6%, so if I put it in the bank, I would have about $650,000 after tax, which quite frankly is the majority of people. So that's what people try and retire on, and then they wonder why they, they don't have a lot of money, because even at a 10% return, $600,000 is going to pay you $60,000 a year, which is $5,000 a month, and then they wonder why 99% of the people don't retire wealthy at the age of 65. Now, hopefully, you're starting to understand the maths. If you're getting a 15% return at $2,000, I'm now well over my $2 million after tax. I'm clear. I'm done. Okay, without any investing in Apple or Wealth Migrate, I'm being facetious as a wealth partner, without any major wins, I'm just plodding along, $2,000 a month, consistently investing and reinvesting, and I've reached my goal. Okay, and if I can get slightly higher returns, I'm well above that. So hopefully this starts to show people now, and we're going to be doing this as part of the accelerator, where all these spreadsheets, we're actually going to be building them into models. Just of interest, who would like these spreadsheets? Because we've actually, Richard and Lee have me working very hard at the moment, and Richard working very hard, because we're taking all the models and the spreadsheets and everything that we've got, and we're actually going to build it into a big model so that people can, I believe that it's very valuable for you to go and play around, because the beauty with these models is you can go and say, well, I've got $5,000 a month, and it immediately automatically changes, or this is 13% because that's what I think I can get, and this is 16%, and boom, you're playing around with everything. So what I wanted to achieve tonight was just to start off with, if you go back to this is the bottom-up process. So it's basically saying, well, I want to send my kid to university. How much does it cost to go to university? And then how much would I have to invest to be able to get there? The top-down process is this one, which is where you're going, well, I want to retire on X passive income. How much capital am I going to require? And then using the same formula to figure out how much it is. And I'm quite chuffed, personally, to know that my number is $2,000 in the next 20 years at a very consistent return, and I hit my result. And I think that's quite exciting. And last night, before I was going to bed, I was giving myself a little pat on the back to say, okay, well, that's very achievable, and I need to make sure I do it. Right, any questions or comments before I move on? Okay, let's rock and roll.
Lots of people in the group chat who are wanting the spreadsheets and all the information that you've shared.
Cool. Okay, so the next thing is that this is a model that I built years ago when we were helping people invest in houses, and I'm not going to spend tonight going through it. It's quite a complicated spreadsheet. It looks very simple, but it's quite complicated, where in the green you can put in all the different variables on buying any property anywhere in the world, with the rates, the utilities, all the finances, everything basically. It works out for you what your total purchase price is, what's the total amount of capital that you require. It works out your cash flow, so how much, because sometimes when you're buying a house, you got to pay a deposit and then the rest, and it tells you, in those days, it was all sort of doing it between dollars and rands. It then gives you your annual cash flow, both in terms of your P&L, taking into account your income minus your expenses, and it also, it had it if the interest rates went down, plus if the interest rates went up. And then something that people don't take into account is that if you look here in terms of returns, you can actually start to see what is the overall return. So what is the return on investment? So I've already spoken to you tonight about ROI versus IRR. What is the ROI per year? What does it mean? Okay, and then also year on year. So that's so it's calculated annually in terms of the return. So remember the numbers we just used. If you're looking at stuff between 13 and 18%, you know, you're going to be well on your way to getting what you want. And then, you know, it gets interesting for me because I get asked this all the time. You know, what happens if South Africa, you know, or, you know, a country like South Africa or India, you know, oh, but I can make more money in India, or oh, I can make more money in South Africa. Well, if you take a country like South Africa, the rand is devalued consistently by 6% for the last 30 years against the US dollar. I actually used 5%. And so if you want to compare an apple with an apple, what would the return look like if I was taking R1 million out and investing it overseas versus investing R1 million in South Africa? What would the return look like? And I'm sorry, but you have to take into account the overall long-term devaluation on a long-term period. And you can see this is a 5-year period. And now you can see the returns are 18, 16, 18, and even 21%. And why this is different as well is you've got the different capital growth amounts here. And this is like the long-term averages, et cetera, et cetera, et cetera. So this is a spreadsheet that, again, you can change the variables up the top and it calculates everything for you. But for the purposes of tonight, these are the things that become important, because if you live in South Africa or China or India or whatever, and you have a currency that's devaluing against first world hard currencies, this becomes a very important calculator to determine whether you should invest locally or internationally, whether you should invest in pounds or dollars or whatever, because it allows you to now do conversions between currencies. It's got all the back-end calculations. I'm not going to bore you with all the rental escalations and inflation and all that sort of stuff. It's also got the tax built in, but really it's what, you know, I can't remember who said this, but simplicity is the ultimate sophistication. And although it looks pretty simple on one page, it ultimately allows you to know the return. So whenever I buy property, you know, in whatever currency, I then use this calculator to determine, because I haven't been able to find one online that could do both the return of the property and take into account currency, so that I could compare an apple with an apple. I could compare investing in South Africa to investing in England. I could compare investing in England to investing in America. That then goes to the next one, which is what I get asked all the time, is, you know, well, if I invest in, you know, Australia or America, you know, what would it mean? And actually, this is where I believe people need to get clever. And don't worry about what the currencies are. You know, so using the models I've already showed you, I then just do what I call asset allocation, and I build out for clients. You know, generally in the past, I was helping high net worth clients when we were helping people invest directly in houses or apartments, you know, to show them what would it mean if you built a portfolio between Australia, Brisbane, Orlando, America, and Atlanta, America. What would it mean in terms of the cash flow? So you can see the cash flow here, because a property in Australia is cash flow negative, and then a property in Orlando and a property in Atlanta is cash flow positive. So what would that mean on an annual basis to your annual cash flow? And then equally, you get different returns in different countries. And then what would the return be? Because different currencies devalue against different currencies. So what would the annual return be? And I'm sorry if I'm sounding like a rocket scientist now, but these are the things that I enjoy doing, because most people make decisions based on gut feel. And I love living in South Africa as an example, but I don't invest anymore in South Africa because it's just purely a numbers game. I just did the maths and it didn't make sense to me. But what it allows me to do is I start to see what is my global portfolio, you know, what is my cash flow return on an annual basis, what is my annual return, which we've been discussing all night, which would be 17%. And if I took my rand devaluation into account, or, you know, currency devaluation, it's as high as 30%. Now, what does that mean? Well, if I leave my money in South Africa and I'm getting 10% in South Africa and I'm getting 30% through this asset allocation, you know, I have to compare an apple with an apple. And this is where it becomes important, because I can now go back and I can say, well, actually, if I take R1 million out of South Africa and you know, and I put down capital, you know, maybe I'm not working on 16%, maybe I'm actually working on higher returns because of, you know, what I'm getting, you know, again, currency for currency, apple for apple. And then the last spreadsheet I wanted to show you was this one here, why is the freedom calculator not come up? Sorry, there's two other ones. Oh, there it is there. So this is the IRR calculator that we actually as the team use. Just by the way, as a matter of interest, this calculator here, I see a future, and unfortunately I always get accused of being like a Steve Jobs or an Elon Musk, where I want our tech team to deliver stuff, today that they're sort of planning on doing in 3 years. But I see a future where I'd like to be able to go on our WealthE Migrate global platform, and I can actually look at all my different properties. I can look at them across different regions. I can see which regions are outperforming other regions. We call it smart investing, where I can take 30 years worth of big data, and I can actually project into the future that if I invest in Australia versus I invest in South Africa, or I invest in Australia versus I invest in England, what will that mean based on my long-term goals? So all the stuff I've explained to you tonight is pretty clear. My goal is $15,000 passive income. And then the calculator, the financial calculators, which we all know computers can do already. It doesn't need fancy artificial intelligence or anything. Can literally say, yep, based on long-term trends, this is going to happen, or no, it's not going to happen. And it can help me make smart decisions. And that's why we call it smart investing. You've got a smart TV, you've got a smart car, you've got a smartphone. Why could you not have a smart investment? And so hopefully you're starting to see how all the little pieces of the puzzle fit together. If you come down to the IRR calculator, this is the calculator that we just use internally. So that we're calculating both with fees or no fees, and ultimately the returns if someone invests $10,000. What does it mean? What is the cash flow? With the fees included, what does it mean? Where does one end up? What is the cash on cash return, etc. So you can actually see that this is just the back end, and I'm just showing you the back end that we use, and that's then what is actually populated in terms of the platform. Now, this is all stuff that in time is all going to be built completely into the platform, so that it's literally just calculated without fail. There's plenty of platforms, plenty of calculators out there. I bought Hannes Dreher's calculator many years ago, back in 2002, I think. I bought Dolph de Roos's calculator called REAP, probably around the same time. They're all much of a muchness, quite frankly. And for me, it's not so much again the calculator, because they're all the same. What's important is being able to compare an apple with an apple, or an apple with an orange, to be able to make decisions. And then the last thing which I want to share with you, which is the freedom calculator. And this is where now you will certifiably think that I have completely lost it. And this is where I like to look at scenarios. And I don't know, Lee, if you've even ever seen these. But what I did when I was buying properties in America, residential properties, both for myself and for other people, I looked at a couple of scenarios. I said, well, as a South African, and please understand, this is not only for South Africans. You could be living in Belgium and you could do this exact same process. If I do nothing now and the currency recovers, because people living in England, and because of Brexit, the pound has been weak, and so they say, well, I'm not going to do anything until the currency recovers. So let's look at the scenario. What happens if I do nothing and wait until it recovers? What happens if I buy now and I benefit from the capital growth and the income, and the currency stays the same? What happens if I buy now and I benefit from the capital growth and the income, but the currency actually improves to the best case scenario, which ultimately means I'm technically losing on currency? What about if I buy now, benefit from the capital growth and the income, and the currency goes to the worst case scenario, which means I'm actually winning on currency? And what about if I buy now and benefit from the capital growth and the income, and ultimately it improves, everything improves to the best case scenario? Now, I'm not going to bore you with the maths, because I could probably spend an hour just explaining the maths and the numbers, but I basically did all the different scenarios, the yields, because often we spoke earlier about opportunity cost. Often people are waiting for the next best thing. The one thing I've learned, there is no next best thing. The most successful wealthy people have the consistency, the passion, and the patience to just consistently invest, in deal after deal, basically. And what it ultimately did is I created this freedom graph. You can see that it gives the numbers right out over a 30-year period. And you're probably not interested in all the numbers, but what you probably are interested in is the spreadsheet. And what it was really interesting to me is that, sorry, I don't quite know how to do this, because if I make it too big, you can't read it, and if I make it too small, I can't read it. Anyway, so let's look at it here. And this is the amount of capital are required based on, and you can see here the dollar net asset value, and you can also see time. What was fascinating is you can see, this option here, which was just keeping money in the bank. So where would you be if you kept money in the bank? This option here was buying a property in South Africa. So this was taking into account inflation and everything else. The green one was waiting a year, but yet waiting, and you actually call it right, and the currency completely recovers. But you've lost a year versus of getting started in terms of compound interest. This one here is actually starting now, and even though the currency improved in value, so technically you lost against currency, the fact that you own an asset that is growing in capital growth and is paying you a passive income, you're actually better off 30 years from now than you are in the previous scenario where you waited a year and the currency improved. And then finally, and we spoke a little bit about gearing and leverage this morning, which is where you borrow bank debt. If you borrowed even at 50%, you can see where you are after 30 years. Now, the capital amount is not that important because it all depends on what you start with. But what I found fascinating when I did this exercise, both for myself and for my clients, and you can see the date here, 2016, I did this. It gave me, very clear clarity that I need to be getting involved in projects where the gearing is at least 50 to 60%. I don't want to go too much higher based on risk. That I need to consistently be investing, not waiting because, based on currency. If I invest in South Africa, I think you can see the results. And if I leave my money in the bank, you can see the results. Can you start to see how, I don't know, to be honest, I need some feedback, Lee, whether I'm absolutely confusing the shit out of everyone or whether it's starting to paint the picture. And I acknowledge that tonight, it's a bit like when my son gets his coloring in book, it's far from a Da Vinci picture, but hopefully at least the black edges are starting to become clearer for people as to how you can bring it all together and use the financial numbers to paint your picture and to give you the clarity and to know what amount of money you need to be focusing on, what type of returns you want to be focusing on, and actually how you can build it into a strategy. I'd love some feedback, Lee, based on all the graphs and everything I've shared, because quite frankly, I've tried to share 20 years worth of knowledge in 50 minutes.
We are getting absolutely positive feedback on the chats and for me as well. It is amazing how much information you have collected over the years and what you do use and how.
Can anyone else hear me?
Yep, can you hear me?
Okay. So I can see some things coming. Maybe Lee's connection sorted. So let's jump now. And let's again turn this into a bit of real life. I think I just want to double check. I think there were 5 spreadsheets. I just want to make sure I've been through all 5 of them. I think I have. Yep, I have been through them. So one of the things we're wanting to do, Richard and myself and Lee are working on, is actually consolidating all of these. And as you know, I built a 4-dimensional model, which is our whole GIDS process. There's a whole bunch of other stuff that we got, and we're actually looking to bring these together in models, and ideally I'd like them all to be in the platform where in a circle people can actually go and build their portfolios and actually then track budgets to actuals, because like any good business, you need to actually have your budgets to your actuals and see whether you're on track or off track based on your big picture of where you want to get to. So let's go back to the PowerPoint, and you can see portfolio strategy, and now you're going to start to see that when you see me present on stage, I literally give people 2 slides because I don't have an hour to explain what I've just explained. But what we're basically looking at here is that Ben wants to save $1,000 per month for the next 16 years, and will he have enough money for his son who's now 2? He's risk averse, but he wants to look for a regular return. Hopefully you're starting to understand what we're talking about now. We looked at a number of the Wealth Migrate offerings. We looked at a multi-family offering, and we looked at a medical offering. One was a 4-year deal, one was a 5-year deal. But the idea is that whatever you get, you reinvest. And so effectively, you've got an average return of around capital growth return plus an average income return compounded over, over the period, and then obviously being reinvested, et cetera, et cetera. And what it basically means is that if you invest $1,000 a month in 16 years, you've got $2 million. The one investment was, I think, the medical investment, which are traditionally sort of 13 to 15%. The multifamily tends to be slightly higher because they've got better capital growth, and you can see that you would be on $3 million. Now, I want to come back to what I said earlier, where I want to earn $15,000 a month passive income. Can you start to see that over a 15 to 20 year period, the numbers are very clear that you need to be investing between $1,000 and $2,000 based on the returns that we've discussed. So I'm sure that most people on this call would be very happy to earn $15,000 a month passive income, completely passive. You don't have to work for it at all. And what you need to start realizing in your head is that the numbers based on a 15 to 20 year period are somewhere between $1,000 to $2,000 a month, consistently investing and reinvesting, and within a 15 to 20 year period, you'll sort yourself out. Now, if you've already got started, you can obviously shorten that amount of time. If you've got more capital, you can shorten that amount of time. And if you can't put in $1,000 to $2,000, like Bongi, who is 17 years old today, turning 18 tomorrow, he's going to start with his $200 because that's all he's got. And he's not going to do $200 a month because that's all he earned from his holidays, and he's in matric, so he's at school, you know. But you can see that even that, with no reinvestment, still over time, you know, has a dramatic impact, not only with regard to the results, but more importantly, even with regards to his learning. So if you've got children, or you've got, you know, you're thinking about your children, you know, I fundamentally believe that no time is it's never too early. My son started when he was 5. We can help people invest under the age of 18. My son, he doesn't know it yet, to be honest, but he's been investing on our platform since he was 5 years old. And hopefully, you know, by the time he gets to university, you might be surprised, he might actually be able to pay for himself to go to university. I've shown you this slide because I showed you it, but now hopefully, you know, if you're in an event and I was talking for 2 hours, you'd literally get to see the slide. Now, hopefully you've seen the maths and the science behind it. You've seen a picture of my son, many of you, and this is him learning, and that's my why with regards to the university. And then the last thing I wanted to mention was fees. You know, a lot of people out there, you know, say to us, well, how are you getting 8% cash on cash return in medical when a medical REIT in America is paying 4.75%? You know, are you guys cleverer? Are you, you know, did you go to better universities? Are you better negotiators? And it's got nothing to do with that. We've just cut all the middlemen out, which has dramatically reduced the fees. And, you know, Tony Robbins did this book, which I would highly recommend, called Unshakable. And if you can reduce your fees by 1%, it equals 10 years of your retirement income. So, you know, where our fees are no more than 3%, you know, the average fees in this game are 6, 7, 8%. And that's the difference. That is what's making such a significant difference to our investors, to myself, because I'm an investor, to hopefully to you guys. And the other thing is when people say, well, Scott, why don't I just give you all my money and you go invest it for me? Because quite frankly, statistically, 96% of fund managers don't beat the 15-year average. And that's because they're taking money here and they're putting it there and they're trying to move it around. And hopefully what I've shown you tonight is that this isn't rocket science. It's actually the consistency that helps you get there in the end. It's the consistency and the patience, the diversification. If you remember that slide from Monopoly, and then just not ending up in jail, which yeah, is the 4 things that it said. So for me, that is actually everything around portfolio strategy. And the last thing I would say is that, you know, you've seen me say this 1,000 times over, but a bird flying in a flock can fly 70% further than a bird flying on its own. You know, you can go out and try and do this on your own, like I did when I was 22 years old. But to be honest, every property that I've ever invested in, I've actually invested with a partner. I've never bought a property on my own. And, you know, I highly recommend that you use nature's laws. And I heard this from Deepak Chopra, some research he did. If you try to do something on your own, if you try and set yourself a 15 or 20-year goal, you've got about less than 50% chance of succeeding. If you do it with a partner, a husband, a wife, a business partner, a friend, you've got about a 60% chance of succeeding. If you do it in a like-minded mastermind or group, you have a higher than 70% chance of succeeding. And that for me is why we created the Inner Circle. You know, as we move into this new decade with regards to, you know, where is wealth going? You know, we've got Society 5.0, we've got Entrepreneur 5.0, we've got Wealth 5.0. It's all around your impact, your creativity, and how you can create value. Your high touch, how many people can you collaborate with? Your high tech, how you can use data, and all around digital as to how you can solve problems. And for me, you know, although the fundamentals of investing, whether it's the stock market or property, real estate, don't change. And we've got a micro degree on the 8 steps to wealth through real estate, to actually taking you through the 8 steps of how you can invest, how you can get these type of returns. You know, ultimately for me, it comes back to the investor test, because when you do the investor test, you get a 26-page report, because whether you're absolutely brand new tonight or whether you're highly sophisticated with a global portfolio, every single one of us is on a journey, and each one of us can improve and grow and learn where we're strong between our investment quotient, our systems quotient, our connected quotient, our financial quotient, and ultimately our purpose quotient. And if you do the investor test, it helps you know where you are, just like a GPS. It helps you know where you want to get to, and it helps you know all the steps between where you are and where you want to get to. And hopefully tonight we've lifted up the bonnet and we've shared with you a lot of the maths behind how you can actually do that and how you can achieve it. So in conclusion, money won't create success, the freedom to make it will. You know, for me, I ask people, what are you doing to be a global citizen? Are you ready for 2020 and the next decade? And you know, we've got access to the deals. You can literally go on the platform tonight. You can start investing from $1,000. You can start to participate. You can get involved in our starter pack, you know, which ultimately allows you to join the inner circle. I've spoken about the inner circle and all the benefits that you get. You know, for me, this is that group of people that want to grow together, want to learn together, want to invest together, want to have a purposeful impact on the planet. And quite frankly, I see a future where we're all going to be setting ourselves goals, just like when we go to gym or whatever, and we actually see whether we're on track or not in terms of where we're going. And that, you know, the feedback we had last year was that Scott, you know, and team, there's a huge amount of knowledge in your head. We've got to put this stuff down simply so that people can know. And so Lee's actually got me recording the Wealth 5.0 Accelerator at the moment. It should be done by the end of the month, which is a step-by-step process to help people go through. And we've actually put it all together in our starter pack, which is where people can now literally, because what we found so often is people come on webinars, they come to live events, and they go, I don't know what to do next. Thank you, Scott. Thank you, team. Lots of information, but quite frankly, it's completely overwhelming and I don't know what to do. We've created the starter pack where literally it gives you a $100 voucher to get going. You join the inner circle, you get access to the eWealth pack, you get access to the micro degrees, you get access to the Wealth 5.0 Accelerator, and most importantly, you also get a wealth assistant, you know, one of our team members that actually can help people's hands and hold them through the process. And so I think that's all from my side. I just want to check here quickly. I don't know why the slide freezes. Yeah, so like I said, in terms of a wealth assistant, not necessarily with me, because there's so much going on at the moment, but we have built a team of people that can help people and actually chat with them one-to-one and help them discover their goals. And so really, I just want to move to questions and see whether there's any questions. I know there were quite a few questions coming through and or comments. So Lee, if you are there, let me know if there's anything. I'll try to read through them myself.
I am here, Scott. Can you hear me?
So for people like Tony and Eugene and Gavin and Deanne and Anthony, it was actually Anthony Kimball who shared those slides. So thank you very much, Anthony. Really appreciate it. For me, it's the power of community. I never thought I would get so much value out of our community. It's one of the things I'm most grateful for. So I can just see you said it was me. So thank you, Anthony. Really, really appreciate it. And that's the whole idea, is that where the world's going in terms of old power was Lee or Scott or someone finding the information and sharing it. New power is where we're working as a community and growing and learning together. So yeah, Jay, I agree very much with what you said around portfolio strategy. So Eugene's asked about the deals, and we've only got 3 currently and 80% funded, so you're 100% right, Eugene. Obviously, coming into the festive period, we struggle to launch new deals because, quite frankly, you know, many of the team need a holiday, and also we find around the world it's not a great time. So we've got a number of great projects in the pipeline and coming up now. There is a benefit to investing in a project when it's 80% funded, because it means it's very nearly closed, which means the cash-on-cash returns will be coming quick, which is always good. Thanks for all the comments. Any chance you can share these sheets, Gavin? We will be, as I said, but I want to organize them a bit better. so that it's logical and easy for people. So we will definitely be, and it will be part of our, what are we calling that? That Wealth Accelerator, in terms of that, with all the documents. Can you see the spreadsheets? Boom, 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 boom. So I'm just looking at all the comments and seeing if there's anything. Okay, gone silent. I hope that wasn't me. Will Wealth Migrate one day allow auto investing at $100? Great question, Gavin. I believe that with our wallets, it's something we very much want to do in terms of auto investing. I don't know if we're going to be able to do it at the moment the wallets go live. But what's great is that, remember, the auto investing won't go into a project because that would make us a fund or a financial advisor. But what we can do now with the digital wallets is you can auto invest into your wallet and you can grow, and then you would still take the responsibility to go and actually invest in the deals. But what I love is that what my wife and I did a couple of years ago is I took 20% of my salary, and it didn't even arrive in my account. 20% went straight into my wallet, basically. And it's just a good way of making sure we don't spend the money, and then the money's there, and it's actually quite easy to put it into a deal when it's sitting in the wallet, basically. The slides, yeah, I'm happy to share the slides, no problem. We'll definitely be sharing all the material with our inner circle, you know, in terms of where we're at. So Anthony said, tips to build income to 1,000 per month in order to invest consistently. So I think that's a good one, Anthony. You know, I think, look, there's a whole bunch of things there. I know that one of our wealth partners, which is our shareholders, is a guy called Ian, and him and I and Lee are actually talking about just ways to help people create more value. The one thing I would say, and my son is 5, well, my son's now 7, but if you ask my son on how to make more money, I don't know, Lee, do you know what the answer is to what my son would say?
Help others make more money, and you'll make more money yourself.
We're not hearing you, Lee.
Everyone else is hearing me. You who's not hearing me.
Me.
It's you.
My speaker's
Can you hear me
died.
now?
Yeah.
There we go.
I hope you were talking previously and I was just talking over you.
Yeah,
sorry about
I was actually, and Alex came on and said, I can hear you, but I don't think Scott can. So it's no problem. But I think Jonty has been taught very well, and he completely understands that by helping others get what they want, you achieve your goals.
That's exactly it. So Anthony, my number one tip that when people ask me is 2 things. One is solve people's problems, and secondly, add more value. And, you know, I always say to my son when he says, I want X, Y, and Z, I always say, well, how can you add more value? So I believe that the way to get any amount of income you want, income or capital, is to add more value. So whether you're an employee in a company, figure out how to add more value. And I'm sorry, I'm actually going to divulge a little bit here, and I'm going to come across here, and I hope this doesn't come across as arrogant, but when I was in London, I worked for a company for 5 years. I started as a sweeper. So it was one of my most humbling experiences, but I literally started as a sweeper on a site, earning a paltry £5 an hour or something, you know, barely enough to afford a beer at the end of the, end of the day. And within 5 years, I doubled my salary 5 times. So that's multiple upon multiple. And how did I do that? I just kept adding value. From being a sweeper, within 2 weeks, the guys were like, this I can't be a sweeper. I became a junior site manager. I was given, I was then given concrete because I was working for a property developer and reinforced concrete builder developer. And so I did the concrete, and that bored the shit out of me because in about a month or 2, I figured out how to do that. I then went and said, right, I want steel. And the guy was like, that's unheard of. Like in England, you literally have one job. Like you're the concrete guy, you're the steel guy. I said, well, I'm bored. Like I need both. And then every time I did that, I equally reminded them that my salary needed to keep going up. And then I became junior site manager. And then I went and found a master's in London, which I did full-time on top of a full-time job. So my job was 6 days a week on the construction site, 8 till 6 Monday to Friday, and 8 till 1 on a Saturday. And I did a full-time master's on top of that. So, you know, I don't have a lot of time for people that give me excuses, and I'm sorry if I'm being direct. That's why I don't make a good coach. But the point being is that I then went to my boss and I said, right, I was like 24 years old, and I said, right, like I've now learned this. I now want to come to head office because as the farmer, it's the farmer in the farmhouse that knows how to make money, not the dude out ploughing the field. And I was out ploughing the field, but now I had a reason to be able to go to the head office because I knew about technology, and none of them could even spell technology. And so at 24, I became group IT manager. I was effectively at board level, but I wasn't. They said I was too young to be a board member, but I sat in on the board meetings. I was the tech guy for a £100 million company. And at 25, I decided I was the world's worst employee and went on my own. So I'm just explaining how I did it, but it's not like I just went in and consistently kept asking for more money. I kept adding much more value and was adding much more value to the company, which ultimately, but then I equally had the guts to ask for an income, a return. So I just wanted to share that, and I'm sorry if it comes across as arrogant. But a lot of people think, oh, but I'm not an entrepreneur, I'm an employee or whatever. It's rubbish. Like, it's always about how can you add more value. And if you're adding value, if you're an employee or an entrepreneur, business owner or whatever, you add more value, you make more money. It's that simple. Rob Smith said, I really enjoyed the diagrams. If they were dynamic, i.e. like YouTube, 100%. Don't understand what you mean. I don't know, Lee, if you do. What do you mean by dynamic? We lost you again, Lee. Anyway, so Rob, I'm not 100% sure what you mean, but I think if I understand what you're saying, sorry, Lee, I don't know if you want to talk there. Sorry, I was seeing your mouth move, but I couldn't hear you.
No, it's okay. Go for it. I was just saying I'm here.
No, look, I think for me, it's been a big eye-opening experience over the last 24 hours because, because Lee's asked me to do this Wealth Accelerator. So she's had me working quite hard in the last day and a half, including preparing for this WealthE Wednesday. And a lot of the stuff's in my head, and a lot of the stuff I've already got spreadsheets for, and a lot of the stuff we've already got PowerPoints for. But what I've realized even tonight, even by doing this, and thank you for allowing me the opportunity to do this, is that it's still not clear and concise, and we need to work harder to make this simpler for people to understand. So, Rob, I think I take on board what you're saying, and our job is to simplify this even further, give people the belief, give them the access, and give them the knowledge, and then give them the access. Finding it difficult to see your webinars due to my timing. Are they recorded? Yes, so everything is recorded and is always posted on the social media platforms. So sign up to the Wealth Migrate Facebook page, join the WhatsApp groups, join the inner circle. If you're part of the inner circle, then we really share as much as we can. Maybe it means interactive. So yes, Anthony, I'll probably agree with you. Agree with what you're saying, Jay. Thank you. The diagram is moving. Often there's someone with a pencil drawing. Oh, I see what you mean. So yeah, like we've got a crowdfunding video. So I agree with you, Rob. Unfortunately, I've done one of those before. We've got a video on how Wealth Migrate works. And although it's only a 2-minute video, it took us like 30 hours of work behind the scenes. So it comes back to what I said. We've got to get clear on how to simplify this message. And if anyone's got any good ideas that's part of the community, we are all ears. Please contact Lee as to how we can take what I consider as quite complicated rocket science and simplify it and dumb it down to make it easy so that we can all understand it. And then, okay, it's great you're talking about trying to manage time, as I think you get it. Yeah. So I think if I understand what you're saying there is that around time is that I started off tonight saying there's no get rich quick scheme. There's nothing I've told you tonight that gets rich. I didn't tell you to invest in cryptocurrency or property or the stock market tonight. You might have noticed. In fact, tonight was the skills I shared with you tonight were irrelevant of the asset class you invest in. However, what you've got to manage is risk, because it's all good and well to say you're going to get 100% return on your investment. But if you lose a whole lot, 100% times naught is naught. And that doesn't change. So just be very careful. High risk, high return, there's reasons that those adages live. And that's why I've tried to show you tonight how you can do this safely, not with crazy investments that don't necessarily make sense. And I'm not saying you shouldn't have a bit of your, probably another, it's the 8th lesson, the 8th pillar in the 8 steps. But it's actually around how do you do allocation of your monthly budget and asset allocation, etc. And if you've got all your money in high risk investments, it's only a matter of time until you bet against winter, till you catch a cold. So you've got to balance it. And if you've got everything in low risk investments, you're probably going to miss out on a few apples and a few Wealth Migrates. Anyway, I'm being facetious. Olivia said, if I'm already a member of the Inner Circle, do I still have to purchase the starter pack? A good question. I don't know the answer to that. I don't know, Lee. I don't know what we decided on that. Well, we certainly got to find a way to make it worth their while. Inner Circle are our trusted Inner Circle community. We'll always make it worth their while.
Absolutely, and we're busy discussing that at the moment. So we will share details closer to the launch on the Inner Circle, and we'll let you know as soon as we have those details for you on how you can get the starter pack and benefit from that if you're part of our Inner Circle.
The reason I've got a green screen behind me here is that's what Lee had me doing all Christmas. So while you guys were having a nice festive season, I had to paint my wall so that we can make these videos professional and everything. So I haven't quite figured out how to put the background in yet, but we're going to for the videos and for everything we're doing. So we very aggressively are trying to take this next step in terms of belief and knowledge as we discussed. I want to, if there's a couple of other comments, fine, but I just want to run quickly to a last couple of things. You know, we always finish with WealthE Wednesday and remind everyone of our social promise. We aim to empower 1 billion people. You know, our manifesto is imagine a world where all people are literate, where education is par for the course, where women are treated as equal, a world where people have access to investment opportunities. Imagine a world where 6 billion people on the planet who currently live in poverty can live a better life, including you and me. Imagine that world, and we're aiming to create that world. And I always share the picture of this young man. I literally videoed him today. He goes into Matric, which is his final year of study. This community, the people that are part of the Inner Circle, the wealth partners, everyone that invests on our platform, are personally responsible. You can pat yourself on the back because we've put this kid through a private school for now 3 years. We're going on the fourth and final year, and he's just the most incredible man. I literally recorded a video with him today on his first day of school, and tomorrow is his 18th birthday. And probably the part that I'm saddest of is I actually forgot to talk about the $200. Well, I didn't know to talk about it because although he reached out to me 2 weeks ago, he only reminded me after the video. And I just think it's the most incredible thing. Everything that we've spoken about tonight, there's a 17-year-old that's made $200, and I guarantee you, while his peers are buying nice clothes and nice shoes, he wants to know how to put it onto the platform. And I think it's a wonderful way to finish off tonight, because it not only shows you your own potential and what you can do in terms of creating your future, but it also shows you the purposeful impact you can have on others. And that's what I believe the Inner Circle is all about. It's about knowledge, it's about community, it's about investing, and it's about purpose and bringing it all together. In terms of the next steps, you can see there, you can go and look up and read up about the starter pack. You know, for me, it's really important to become a global citizen. If you're watching the recording, you can click on the links below. You've got, you know, Lee's details, you know, as head of our community. She does a wonderful job. Most of you don't know all the stuff going on behind the scenes to enable this community and to try and add value to this community. And, you know, thank you again, Lee, from my side. I really, really appreciate it. And yeah, I don't know, Lee, if there's anything else from your side. That was everything I wanted to run through. I can see Gavin here is saying budget allocation. So I would recommend, if you want to, you can go, Gavin, because I know you're part of the Inner Circle, you can actually go straight to the micro degree and go and look up step 8, because that's actually all around budget allocation. Thank you, Francis, for the kind words. Thank you. I don't know if it's Olive or Olivia, so I apologize. D-Row, I've invested before and lost track of the investments. How do I avoid your investment disappearing? So yeah, that's you know, that's one of the reasons why we created the platform, because I'm terrible with admin. And you know, and one of the things I love about the platform is all my investments are all in one place. For the legacy investors, they've actually been moved over now with our wallets. All the money's coming into one global wallet system. Whether I invest in England, Australia, America, South Africa, it's irrelevant. It'll all be in one place. And hopefully, you know, tonight we've shone a light on the vision of where we want to go, because I would like to believe in the next couple of years, every single thing you've seen, every spreadsheet, every PowerPoint, everything is actually built into the system so that you can ultimately be a smart investor. And as you might or might not have seen, one of our dreams is to put smart investing in every single person's pocket. That's all from me, Lee. Thank you very much for tonight.
Guys, thank you very much for joining us. It was great to have you share with us, Scott. Thank you. I know that you've got so many balls in the air at the moment, and most of them are from me. So we do appreciate you taking time out and sharing with us. This was valuable. We will share the links to the recording as soon as it is downloaded. And we look forward to seeing you guys online again for WealthE Wednesday in February. If you have any queries or need any further information, in the meantime, please feel free to reach out, and I will either answer you directly or get one of our customer success team members to get hold of you. But thank you for your time. Go well, be blessed.
And one last thing, Lee, that I forgot to say is that if we've added value to tonight, the only thing we would ask for in return is please share the knowledge. Please let other people know what we're doing. Invite them to future webinars. Share the links. You know, we're not going to empower 1 billion people on our own. We're only going to be able to do it collectively, and that's all we ask for. You know, we're not charging any money for this or whatever. We're trying to share the knowledge for free, but our request is that if we've added value, please share it with others, and hopefully that comes back to the question Anthony asked earlier around how to make more money. It's by adding more value to more people. Good night and thank you.